Let's talk about some of those big earnings right now. Stephanie Link joins us from Hightower, Chief Investment Strategist and Portfolio Manager, also a CNBC contributor. And again, Stephanie, we're just digging through these numbers, too, with all of them hitting around the same time. JP Chase right now is trading a little bit higher. What have you seen just off of the very quick numbers on this? And I'll tell you again, net interest income at JP Morgan, since it's still hitting, I don't even know if you've seen it, $24.2 billion.
So there was a really tough setup for the banks heading into the print, because a lot of these stocks are up 25 to 35% from the lows. And the fourth quarter is typically very messy for banks. And we're seeing the mess here today. Obviously, the FDIC assessment, everyone is going to have to see that hit, and that's not a surprise at all. But the quarters overall, they're kind of mixed, right? I mean, net interest income was expected to be like steady to down a couple of percent for the group. Fees really disappointing on investment banking and trading, offset by strong credit cards. Kind of seeing that, but very good expense control. So the bottom line number is coming in better than expected. I think the asset quality so far of what I've seen, fine. And the deposit flow is actually a little bit better. Bank of America, I don't think that net interest income number is a surprise at all. In fact, 14.1 billion is a little bit better than the 14 billion that the consensus was looking for. And Brian Moynihan, the CEO, has talked about the net interest income. We're in the process of seeing a trough, and I think that's right for the group. But again, I think it's
Stephanie,
just
to emphasize that the market is agreeing with you at this point too. Bank of America was down 5.4% at one point. Right now, it's only down by 20 cents. That's a decline of about 0.7%. So it's come back from what the knee-jerk reaction was. JP Chase is now up by better than 2.1%. Wells Fargo is now up by almost 1% too. So this could be a knee-jerk reaction to a very noisy and messy quarter with a lot of moving pieces in this. Joe, what are you saying?
They're now saying that so JP Morgan, I guess, earned 357 last year, and this was down, it said 302, which would have been a down year. Now, excluding one-time items, it's 397.
So
which
it is up.
Is above the consensus estimate of 335. They took, it's kind of interesting, we forget, but JP Morgan, the other big banks, did have to pony up for some of the problems at the regional banks. $16 billion and $3 billion is going back into that fund. JP Morgan, I guess, earmarked that to go back in, which was one of the reasons it was down from 357 last year to I guess a gap number of $3.
Look, some of these numbers were already explained. Bank of America explained in December at that Goldman Sachs conference. But because there's so much noise, I think it's just taking some time for people to roll through all of this and try and figure out what they really think about some of the numbers. But Steph, go ahead. What are your thoughts?
Yeah, and I would totally agree. Again, really messy. We have to dig into more of the numbers, but I think they kind of are as expected. The question is, again, these stocks rallied so much from the lows, from the October lows, so maybe just a little bit of a give back. Becky, these stocks are really cheap. I mean, you're getting Bank of America for 1 times book. I mean, that to me, and Wells Fargo 1 times book, and even JP Morgan, which always trades at a premium, is at 1.6 times book. I mean, typically that has been over 2 times, and so you get pretty good yields. The capital levels are really great. I'm just looking through some of these things. These CET1 ratios are all better than expected, and so you feel pretty good about that. And so, look, if you think that the net interest income is at a trough, and you think that capital markets is also improving, which I do, and that wealth management throughout the year should be better, then I think these stocks, the setup into the year, pretty good.
Let me tell you right now the forecast on some counts from JP Morgan, because this is probably more important than what the numbers are that we're just digesting from what's already happened. They're looking for 2024 expense outlook of about $90 billion. They expect fiscal year 2024 net interest income of about $90 billion, market dependent. They're looking for $88 billion in net interest income ex markets for 2024. And they're expecting 2024 card services NCO rate of less than 3.5%. What does that tell you?
Well, I think I always care about the expense line because they can really rein it in when they need to. But they also like to spend, obviously, on investments in technology, and that's what they should be doing. I think $90 billion guide is pretty good.
Yeah.
Yeah, that's pretty good. Yeah, I think that's fine. They probably this year did about 85 billion. So it's not runaway expenses, and I think that's really good. Yeah, no, I think that's fine.
Okay, and again,
I also think
go ahead.
I was just going to say on Wells Fargo, want to listen to what they have to say with regards to net interest income. Remember this year, Wells Fargo raised net interest income 3 times. So the expectations were high. They guided lower for 2024, but I think it's not as bad as expected. So we're going to hear a little bit more of the inputs there.